Good evening and welcome to another episode of Night Markets, where each week I'll be giving you my perspective on what's driving markets, as well as my point of view as a family office professional. My name is Jacobus Brink, the Chief Investment Officer and Head of Investment Research for South Africa at SFO. In a fairly tumultuous week, after recovering from the largest sell-off in nearly 2 years, the major indices concluded the week only slightly lower. The Nasdaq Composite was down 15.81% from its peak, having entered a correction territory the previous Friday, while the S&P 500 index was down as much as 9.71% from its intraday high in mid-January, bringing it close to correctionary territory on Monday morning. The fluctuations in the volatility index, Wall Street's fear gauge, were even more pronounced. On Monday, the index momentarily reached its highest level since the late March 2020 COVID pandemic at 65.73, before gradually declining to end the week at around 21. But before we unpack the movements in the markets, let's just check in on the situation in the Middle East. On Saturday, Israel conducted an airstrike on a school in Gaza City, where displaced Palestinians were sheltering. The Israeli military claimed that it had struck a command post of militants from Hamas and Islamic Jihad, an allegation that the two organizations both rejected. In the southern Gaza Strip, Israel extended evacuation orders in Khan Yunis overnight on Saturday, resulting in evacuation of tens of thousands of Palestinian residents and displaced families. The Israeli military claimed that it was targeting militants from the Hamas group, which was responsible for the administration of Gaza prior to the conflict starting. The militants were employing the areas to launch rockets and conduct attacks. The US indicated its concern about the recent airstrike, adding to the condemnation of the attack from several Arab states, with Turkey, Britain, and the European Union's foreign policy chief also reiterating calls for a Gaza ceasefire. The US has been subjected to increasing domestic and international criticism, including from human rights organizations, as a result of its military assistance to Israel. The airstrike on Saturday occurred one day after a State Department spokesperson announced that the United States would allocate $3.5 billion to Israel for the purchase of US military equipment and weaponry. These funds were appropriated by Congress in April already. The situation currently remains fairly volatile, and the risk of it spilling into a larger regional conflict still remains fairly elevated. Moving on to the markets and the macroeconomic indicators, continued concerns regarding the adverse economic developments of the previous week in the US, particularly the unexpected rise in the unemployment rate and the negative manufacturing signals, was the main factor driving markets during the week. The fluctuations were also partially attributed to technical factors as well as program trading strategies. The recent modest increase in Japanese short-term interest rates appeared to have led to a partial unwind in the so-called carry trade. The carry trade basically involves investors borrowing at near zero-term interest rates in Japan and subsequently investing the funds in high-yielding assets in the United States and other emerging markets. However, these trades started to become unprofitable due to the significant increase in the yen over the past few weeks, which was resulted in a significant number of investors exiting their positions. Looking at some of the macro data, data from S&P Global presented a somewhat divergent perspective as the services sector activity index experienced a slight decline in July from the 56 number reported in June, but it did remain firmly in expansionary territory, completing its fastest 3-month growth period in 2 years. In the same vein, the Institute for Supply Management's Competitor Index rebounded from a contractionary 48.8 in June, its lowest reading in more than 3 years, to 51.4. A bounce-back rally was partially attributed to a reassuring decrease in weekly unemployment claims on Thursday, as the S&P 500 achieved its largest daily gain since November 2022. The number of continuing claims increased marginally by 6,000, despite the fact that weekly claims decreased from an upwardly revised 250,000 to 233,000. Investors also appeared to revisit the household unemployment survey's increase from the previous week, with a particular emphasis on the role of Americans and recent migrants who are not included in the weekly claims data, who have recently reported that they are seeking employment. We also saw a number of earnings announcements during the week, and during earnings calls, numerous significant companies disclosed indications of declining consumer demand. Yum Brands reported a decrease in sales at its KFC and Pizza Hut franchises, while Airbnb, Marriott, Hilton, Delta, United, and Disney all reported a decrease in travel demand. And then just looking at the market performances for the week, all the indices ended a very volatile trading week, only slightly lower, with the Dow Jones and S&P 500 both ending the week fairly flat, and the Nasdaq ending slightly higher by 0.37%. Then moving across the pond to the Eurozone and the United Kingdom, in June, retail sales volume in the Eurozone unexpectedly decreased by 0.3%, following a 0.1% increase in May. This weakness was indicative of a decline in the sales of tobacco, beverages, and food. The data also indicated that consumers are experiencing a delayed recovery from the inflationary pressures we saw earlier, which has exacerbated concerns regarding the strength of demand in the second quarter. Industrial orders increased by 3.9% on a seasonally adjusted basis, while German industrial output also increased by 1.4% sequentially in June. Both these data points exceeded expectations, which is definitely a positive thing. This strength was in stark contrast to the most recent Purchasing Managers Index final estimates, which suggested that the manufacturing sector's downturn continued to deteriorate in July. And in July, the housing market sentiment in the UK appeared to shift towards a cautiously optimistic tone, bolstered by the new Labour government's commitment to enhancing residential development, as well as reducing interest rates. The Royal Institution of Chartered Surveyors reported that its measure of anticipated sales over the next 3 months had reached its highest level since January 2020. And a measure of new buyer inquiries has actually turned positive for the first time in 4 months. In the fixed income markets, Eurozone government bond yields rose across the curve, climbing from lows earlier this week after the global market rout sparked by worries about economic growth. And looking at the equity markets in local currency terms, the Pan-European Stocks Europe 600 index clawed back sharp losses on Monday, to end 0.27% higher. And then moving further east to the Asia-Pacific region, Monday saw the most severe one-day sell-off in decades in Japan's stock market, which were influenced by a rebounding yen following the Bank of Japan's hawkish turn at its July meeting. At the meeting, the Bank of Japan raised interest rates and detailed plans to curtail its bond purchases going forward. In anticipation of a narrowing US-Japan interest rate differential and a stronger yen, investors continued the rapid unwinding of the yen carry trade as concerns about slowing global growth dampened risk appetite. The dovish remarks from Bank of Japan Deputy Governor Yoshida, who stated that the central bank will not raise interest rates when markets are unstable, partially alleviated the global market volatility. This reduced the probability of a near-term rate hike by the Bank of Japan. Subsequently, the yen also experienced a decline in value due to these remarks, and it ended the week at 147 to the US dollar. The yield on the 10-year Japanese government bond decreased from 0.98% at the previous week, end of the previous week, to 0.86%, as investors continued to evaluate the BOJ's monetary policy outlook. The policy board members of the Bank of Japan noted in their July meeting that the economic environment had become more conducive to tightening, with the need for cautious consideration of future policy changes and upside risks to prices. This unexpected upside surprise was primarily due to a significant increase in the volatile special payments component, which reflected summertime incentives. Scheduled earnings, which are the more critical indicator for the Bank of Japan to evaluate wage developments, also increased. Then moving across to China, Chinese stocks retreated as stronger than expected increases in consumer prices failed to offset concerns about deflationary pressures. In July, the consumer price index in China increased by 0.5% from the previous year, following a 0.2% increase in June. The increase was described by analysts to seasonal factors, including a low base for pork prices in 2023, as well as adverse weather conditions. Bloomberg also reported that core inflation, which excludes the volatile food and energy components, increased by 0.4% in July, a decrease from 0.6% in June, and the lowest growth rate since January. The producer price indices also experienced a 0.8% decrease from the previous year, which was consistent with June and represented its 22nd consecutive month of decline. Nevertheless, the composite purchasing managers index decreased from 52.8 in June to 51.2 in the previous week, as the manufacturing PMI unexpectedly contracted for the first time in 9 months. The uneven growth of China's economy was underscored by the mixed PMI readings, which occurred in the midst of a protracted property downturn that has impacted domestic consumption, despite the fact that manufacturing and exports have demonstrated strength. In July, imports surpassed expectations, increasing by 7.2% from the previous year, following a 2.3% decline in June. Sluggish demand resulted in a lower than anticipated 7% increase in exports in July. The decrease in exports has prompted apprehension regarding the potential for a decline in global demand, which has been a critical factor in China's economy this year. And just looking at the market performances in China, the Shanghai Composite Index fell 1.48%, while the blue chip CSI 300 also gave up 1.56%. And then bringing it back home, locally in a holiday-shortened week that was also particularly quiet on the macroeconomic front, the local markets pretty much traded broadly in line with developments globally. After initially selling off during the start of the week, the all-share index ended the week higher by 0.25%, with a fairly mixed performance by the various sectors, with the rand-edged industrials ending higher by 1.61%, and the resources sector ending lower by 1.14%. The rand also ended the week more or less unchanged at 18 Rand 31 to the US dollar, in what was an extremely volatile week that saw the rand trade as high as 18 Rand 70 to the US dollar. And then just looking at the week ahead, investors will be focused on critical inflation data out of the US on Wednesday, in order to gain some insights into the potential magnitude of the Federal Reserve's potential September rate cuts. It is anticipated that the July CPI data will indicate that inflation has continued to approach the Federal Reserve's annual target of 2%. However, a reading of only a slight amount of cooling could alleviate concerns that the Federal Reserve has caused the economy to fall into a downward spiral by maintaining rates at an elevated level for such an extended period. In addition, the weekly report on initial unemployment claims is included in the economic calendar, as well as retail sales figures for July. The earnings season is currently in its final phases, and the majority of companies have already disclosed their quarterly financial results. However, Home Depot and Walmart are among the notable companies that are scheduled to report in the upcoming week. Investors will indeed be very attentive to these retailers' statements regarding the resilience of the consumer spending, which is a significant contributor to economic developments in the country, and in the light of recent indications of economic weakness. A series of economic data is also scheduled to be released in the UK, which will influence the outlook for monetary policy over the next couple of months. On Tuesday, wage growth data is scheduled to be released, followed by inflation numbers the following day. And these figures will be closely monitored for any indications of persistent price pressures, particularly in the still very hot services sector. The economy is anticipated to have expanded 0.6% in the second quarter, despite the fact that the monthly GDP data on Thursday is expected to indicate minimal growth in June. Retail sales data out on Friday is also expected to increase in July, following a decline in the previous month. And then, as always, we'd like to end off with an interesting investment idea we discussed during the week. This week, we were wondering, are markets underpricing the US election risk? Is the risk to a violent US election outcome something that markets are currently underpricing. We do acknowledge that this could be a bit sensationalist, but I suppose these type of black swan events typically are. Contrary to popular belief, the black swan theory, unlike the more frequent tail risk events known as grey swan events, describes an event that comes as a surprise, has a major impact, and is often inappropriately rationalized after the fact with the benefit of hindsight. We will need to see a peaceful election and bipartisan acceptance of the election outcome before we believe we will be out of the woods as far as these risks are concerned. Thank you for joining me for another episode of Night Markets. Financial markets close at 5 p.m. Night markets open at 6 p.m. Let's start the conversation.